Good morning, guys. Thank you so much for watching my YouTube channel. Today I'm going to talk about some of the stocks, and in fact we are going to see Nvidia, Apple, because I think Apple is almost the time to buy. Nvidia is already skyrocketing, but I would like to go to play what Tom Lee is talking about it, and then we are going to see the other stocks like Apple and Nvidia, and also Tesla.
Look at you, investing like you run the
streak going for stocks. We've above 5,800 for the S&P for the first time ever, though it seems to me from your notes that you're a little bit cautious as this month progresses. Why?
Well, Scott, we're cautious, but we advised our clients to be buying the dips. And the reason we're cautious is that I'm probably saying something very obvious, but I think investors want to see who ends up becoming president after election day. So I think we are in a period where markets are just sitting on the sidelines, but at the same time, 2024 has been such a strong year, Scott, that I think the last 2 weeks have proven that maybe macro is taking a little bit of a step back now, and liquidity and all this cash on the sidelines is really the dominant factor.
You think we just have to get the election out of the way, and then it sort of clears the way for what you still think can be a pretty decent rally? I think your target's 6,000 or around that.
Yeah, Scott, there's a lot of firepower supporting stocks post-election, because we've got a Fed that's dovish and the economy looks healthy. I don't think we're in a recession. And the 3-month and 6 are very strong for stocks. And I think China, while there's maybe some hesitation, but China's government is really starting to unleash some measures, and that's supportive of that region finally turning. And of course, the third factor is I think after 2 years, investors who've been very cautious are starting to realize that, the $6 trillion of cash on the sidelines and the low levels of margin debt need to be put to work at a time when the Fed is supporting the economy.
The other possible headwinds, I think, are ones that are maybe outside of the political cycle, at least as people, refer to them. Valuations, they say, are too rich or stretched, right? The S&P is about 21.5. That's above, obviously, its historical average. Yields are up. Now, you could make the argument that they're up for the right reason, but I think they're still up a little bit more than people thought they might be after the Fed did its 50. And then if the Fed's going to be a little bit slower and smaller in the way they progress with rate cuts, is that an issue? Of course, the flip side of that is, well, why would they need to do anything anymore anyway? Because the economy is as resilient as you just suggested it is.
Yeah. Well, on all those points, Scott, on valuation, I know people use the aggregate number for the S&P, but it is misleading because, as we know, the top 7 stocks do have a higher deserved multiple, and the median PE, it's not that much cheaper, but it's around 18 times. But that's not a bad deal considering the 10-year yield is actually a 25 PE. And with regard to the Fed cuts possibly slowing, I think what really matters now is the Fed is on a path to essentially normalize interest rates back towards neutral, because the inflation pressures are ebbing. I think even CPI this week, even though it was a little hotter than expected, really didn't send a signal that inflation's reaccelerating. And so the Fed is, on a path towards 3%, and I think that's really constructive for stocks.
Well, let's say we can all kind of come to agreement, because I think we could say that the consensus is bullish at this point. People think stocks are going to go higher from here because of the economy and rate cuts. The principal disagreement among the crowd at this point appears to be where. Where do you need to be positioned to take advantage of a market that looks like it really wants to go higher? You obviously have suggested that small caps could have the opportunity to have the biggest jump between now and the end of the year. That's a controversial view because, if yields are elevated, if the economy is slowing at least a bit, or there are questions around it, maybe those stocks don't do as well. I thought it was interesting, the thoughtful commentary that Ricky Sandler put forth of Eminence yesterday on social media, to where he says the best place to play offense, and he thinks you should play offense, are in below mega cap companies that have interesting earnings equity stories. At mid to large cap, not mega, but mid to large, and he doesn't say small. So how would you argue your points against those?
I mean, I'd say that we're on the same side of that line, which is market breadth is expanding, and he sees a better risk reward in mid to large, just because I think there are some reasons. There's argument that maybe you can find higher quality and longer histories, but I think that small caps really do perform when the market is believing we're having a soft landing. I don't think that they can make that case in their mind yet until after Election Day, whether or not Harris or Trump is president. But I think once we're through that period, I think small caps not only have underperformance as a tailwind, but it's really, and I know I'm repeating myself, but median PE of a small cap stock is 10.7 times. It's like 7 turns cheaper. We're already looking at third quarter earnings growth of 43% versus around under double digits for S&P. So you're getting better growth. But I think small caps probably do better if Trump wins, just because of potential for deregulation and M&A. So I think that's why Election Day probably is a pivot point for small caps.
Would you agree with Mr. Sandler that, the market at the index level is both expensive and consensus, and that's why, he has the urge to look elsewhere? Mega caps are underperforming, or at least the NASDAQ is today, and maybe that's how the story is going to end up playing out for at least two of those reasons that he mentions.
Well, I think if someone thinks PEs mark the top of stocks, then people are cautious. But to me, the PE is rising because the U.S. economy and companies survived a stress test, Scott. We had a pandemic, we had global trade stop, we have a huge inflation cycle, the Fed, the fastest rate hikes in history. Let's say 4 things that just bombarded corporate earnings, and companies are producing record profits. So to me, they survived a stress test that warrants higher multiples. I just don't personally think 20 times for a category leading company is expensive, even 25 times. And like if we're talking about NVIDIA, why I'm not sure the cap should be 30. So I think that we have this uncomfortableness because PEs are rising, but I think companies have really survived 4 cataclysmic stress tests too.
Tom, let's broaden the conversation. Let's welcome in some guests. Shannon Saccocia of NB Private Wealth, RBC's Lori Calvasina are with us today. Shannon's a CNBC contributor. It's great to have you both with us. Lori, you're reasonably cautious on this market.
So guys, let me highlight what Tom Lee say. He say buy the deep stock, and guys, let me tell you which stock you should buy. So, like this week, when you see the market here, there is something special about Apple. Apple is above here, which is bullish. This one you can buy, and I'm actually 100% Apple is going to buy this dip, because this thing is going to go higher after Apple, because I was running everything when video was going on. Another one is Amazon. So Amazon is already going to signal sell, not sell, but buy this week. By Tuesday, Thursday, we are going to see Amazon breaking all-time high, which is 196. Yeah, 196 or to 200. Amazon, it has good chance, and Apple. Tesla, you should now this year. Tesla right now is already on 100 moving average. It bounces on this week that area, and probably guys, Tesla when Tesla started dumping is always dumping. It's always plus 100 or a plus or a minus. So from the top, and remember once 260, and right now is 217. We are waiting to see if this 217 is going to hold. Let me make sure which 216. If this 216 is not going to hold the Tesla, we are going to see another 200 moving average at 202, and that one, guys, probably 202 will be the next stop of Tesla. guys, Tesla sometimes very hard to say. Yeah, it has a strong sell, so it's sell on Thursday. Like I've already say it will be plus 100 or a negative 100. So okay, from here even 160 Tesla is very easy. 160 or a 360. We are ranging between those area plus or a negative. So guys, another stock which is it has highest chance when I was running, the stock which will be very risky right now will be Nvidia. So when you see Nvidia is already at the high on MACD at the top. Even you see, if you want to know MACD on this one, anytime the previous time it reached $10 on MACD. Right now we are on 4. I don't know if we are going to reach that area, yeah, until earnings. So earnings is going to come on Thursday, November. I don't know, I think we have some one dip before earnings. Another one I saw, Meta also is already almost signaling sell. Yeah, and Apple weekly is already on sale, so which is we can see some few pumps on Apple. So guys, AMD is also signaling maybe we are now above 200 moving average, which is we are not consider on MACD match, we are consider on simple moving average. So guys, thanks so much and have a nice day.